Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what we would be looking at here is starting off obviously with a owning the strike at the 73 strike, and recognizing, of course, that if the stock the underlying security, in this case the EUI, just stayed at 73, we lose the entire premium that we purchased as far as the call option is concerned at the 73 strike. But the fact that we sold the 77 calls here and we collected $1.05, our net loss on that particular position is decreased from $2.60 to only $155 or $1.55. So we lost on the June call, but we managed to keep the entire premium. On the June 73 call, we managed to keep the entire premium on the 77 call. Consequently, we lowered our risk exposure down to $1.55 instead of $2.60. Now, you'll notice that as the underlying continues to drop in value, remember we were bullish, we cannot lose any more than the premium that we paid. So yes, our maximum risk exposure on this long call option is certainly $2.60, and we've lost it, and we can't lose any more. We can't we can't gain any more on the 77 calls. So consequently, our loss is capped at $1.55 per spread, regardless of how low the pair value goes. Now, on the other side of the equation, if the underlying begins to increase in value, we jump from 73 to 75. Well, we've lost, in fact, $60 on the 73 call, because the difference between these two strike prices is $2, but we paid $2.60. But we, in fact, got to keep the $105 that we sold, that we collected from selling the 77. So we end up making 45 cents, because remember, our net cost basis on this particular trade is $1.55. If the pair value continues to increase, we can see that we start to generate on expiration we start to generate a decent return on the call option. We can't make any more on the short position, and so we start to see that our net spread profit increases. We're now at $1.45. We now hit the strike of 77. We're at a $140 profit on the 73 call. We get to keep the 105 profit from the 77. These options expire worthless. Our net profit is $245. Now, if you had just went in and purchased that straight call option, we would be able to continue to enjoy profits the higher this pair value goes. But since we sold the 77s, we can only make the profit up to the strike price that we've sold. In this case, we're the 73s that we bought are worth $4.40, but the 77s are now worth $1.95. So although our 73s continue to increase, we're now starting to lose on the 77s, capping our profit potential at the $245 here. But again, in periods where option premiums are high, we can use the debit spread as a means of offsetting that increase in volatility. So we in fact have somebody else help pay for our expensive options. Now, if we look at essentially a standard risk-reward profile for this debit spread, you can see that our maximum risk exposure here is capped at our $1.55 or $155 per debit spread. As we begin to see the pair value move in our favor, you'll notice that we enter into a break-even point just beyond our 73 strike as we start to trade higher than the premium, that $1.55 that we paid out. And you'll notice here, of course, that our profits are capped at that $245 or $2.45, regardless of how high the options. Regardless of how high the stock actually or underlying security actually trades. So what's interesting, I think, and I know John just had a sort of a comment. Do the 73 calls and 70 call premiums not vary as they increase from 73, 72, 71? You're going to see adjustments on these premiums absolutely as the market moves in any one specific direction. What we're looking at here is the value of these options on expiration, when all of the time value premium has been depreciated out of the contract, and we're strictly looking at what the position is worth based on intrinsic value. But certainly, as the market begins to move in your favor, all of the option contracts will be adjusted accordingly. So let's move forward, and let's look at if we had a bearish outlook on a particular security. So let's say we had a bearish outlook on one of the pair values that we follow. Well, what we could do is we could buy one put option that is relatively close to where that pair value is trading at presently, and we could then go in and sell an even lower strike put option to collect the premium. We're going to do this on the same pair value, and we're going to do this with the same expiration. Now, there are actually variations to this strategy where you would buy a near-term month, and you would sell an expiration month that is in fact further out. That's known as a calendar spread. But this is also a variation of a debit spread whereby you're looking to offset some of your initial costs on an expensive option contract by being a seller. So let's say, for example, that we felt that the YUK, the U.S. versus the yen, was going to continue to decrease in value. Yesterday, the YUK was trading at 89.50, so we might go out and we might look to buy one 89.50 put option and pay $2.80. Well, we may look at this as an expensive proposition. We may not want to put that much capital out. So we're going to go and we're going to look at some alternative strike prices, and we could go down and we could look at the 86 strike puts, and we could see that they're in fact trading at $1.50. Well, we can offset our initial cost by selling those 86 strike puts. In this case, we've lowered the cost basis of this particular strategy all the way down from $2.80 down to $1.30. When we look at how this ultimately ends up, if the underlying security stays at $89.50, which is the strike price of our initial position, we're going to lose the entire premium, because obviously, remember that time premium is the highest at the money. We bought an at the money strike option contract. We paid all time premium, and consequently, if the underlying doesn't move, then all of the time value will have depreciated. For the option buyer, that results in a loss of the entire premium. But for the option writer, that means that we get to keep the entire premium. So in this case, we lost all of our $2.80, but we kept all of the $1.50, resulting in a net loss of $1.30. Now, as the underlying security goes up in value, okay, recognize that it's going against us, but we cannot lose more than the original premium paid. So no matter how high the underlying security goes, we cannot lose any more than what we've paid out for this position.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.